I would like to thank the ADBA once again to that give us a chance to share the Thailand's experience. So let me begin. So we will have a look at the overview of the private debt profile in Thailand, and then we will focus on household debt because that is where our concerns are. And then I will talk a little bit about debt deleveraging, especially on different types of deleveraging and what can we do to support that process. And as Mohan mentioned yesterday, that macroprudential policies are very difficult to evaluate. I want to discuss some ideas on that. And then lastly, my colleagues will end the presentation with Thailand experience regarding the macroprudential policies. So let's have a quick look on the debt profile in different sectors. We can see that both the household debt to GDP and the corporate debt to GDP, they are at a similar level, just slightly a little bit below 80%. But the speed of leverage is different. And on the right-hand side, which we use the BAS data, a little bit different coverage than the Bank of Thailand data. You can see that Thailand's household debt profile is very similar to those in Korea and in Malaysia, both in terms of the level and in terms of the speed of change. Now, house price is not the whole story for Thailand. We have experienced a number of both positive shocks and negative shocks. First, the financial inclusion has improved. This is evidenced by the falling share of informal debt. As you can see, the graph on the left-hand side, this is taken from socio-economic surveys, which cover about 40,000 household survey conducted by National Statistics Office, which is done every 2 years. And second, we experience a severe flood that spans over 6 months. This is one of the most disastrous natural events that we experienced. And a lot of people have to rebuild their houses. They get their car repairs. And third, this is one that I want to stress, the government policies has its own contribution to on the leverage of household debt. Because we introduced first car tax rebate scheme, which is about 100,000 baht, or equivalently, that is like a 15% off car sales for the first car owners. And the government also introduced agricultural price guarantee on rice, and that shaped expectation of farmers that they will have their income, high income in the future. And as we know, the smoothing consumption theory suggests that they want to smooth their consumption and they might borrow. And of course, the monetary policy itself has its own contribution after the global financial crisis. Now, if you look at the graph on the lower right, we can see that the contribution from auto loans, which is the light blue bar, and the contribution from personal loans, which is the orange bar, contribution to household debt growth contribute a lot during 2012 to 2013. Now, after the effect of those government policies died out, you can see that household debt decelerate quickly, which grow at about 3.4% at the end of last year. In fact, it has become very slow. Debt growth has been slow to the point that we actually start to see the falling ratio of household debt to GDP. And if you decompose the component of the change, the contribution of the changes in household debt to GDP, we can see that the momentum of debt creation has been falling rapidly, while the nominal GDP has increased. Note that I swapped the sign of the contribution of nominal GDP, because usually an increase in nominal GDP would have a negative contribution to the ratio. But for the ease of visualization, I swapped the sign. So whenever the contribution from nominal GDP is above the debt creation contribution, then we will have a debt deleveraging. And again, if we use the household survey data, we will see that the deleveraging is not broad-based. Only some group, especially some high-income group, that start to see that debt-to-income ratio falling. And we have seen a lot of literatures, including the one of the paper yesterday discussed that household debt has a short-term positive impact and long-run negative impact. Let me summarize the pattern that we often observe during the two period. So during the leverage period, household borrow, so we will see that the consumption growth will grow higher than income growth. And at the same time, their saving rates falls. Now, the pattern of consumption growth growing higher than income growth cannot last forever. At some point, debt limits will be reached, and the things will start to reverse. And that is when we enter the deleveraging period. And the graph on the right-hand side, lower right, is just to confirm that picture that household saving rate has been falling during the leverage period. The latest data that we had from the National Income Account is 2015. So the deleveraging period starts from 2016. So we expect that household saving rate could rise as we speak. But the point is that deleveraging hurts economy. So one will have to be aware of the adverse effects that it could be costly if you don't monitor it closely. So I want to discuss different types of debt deleveraging. So if instead of using debt to income, if I just use debt to GDP, there's three ways that this ratio can fall. First, debt has to fall while the GDP increase. Or second, debt falls, but falls faster than the reduction in GDP. Third, debt increase, but increase at a slower rate than the increase in GDP. Now, these three types, I want to say that only type 3s are the one that is healthy, because in the normal time, debt level has to increase due to demographic factors. You have positive population, you have better financial development. If debt level has become is falling, or a negative debt growth, is usually a sign of something is wrong with your economy. Perhaps the financial sector has a bad balance sheet, or perhaps it is the correction after the over-excessive lending, if the debt growth becomes negative. So only the third case, that is when we have a healthy deleveraging. Of course, there's no government authority in the world that has explicitly target the private debt to GDP level. It's no one does that. So this slide just gives you a few instruments and tools at what affects what. So basically, and each of the instrument has its own constraint. So we have to assess the condition and the constraint of each instrument. So for example, if the private sector is in deleveraging period, we wouldn't want to see that the public sector is deleveraging as well, because that the deleveraging may not be successful then, because we will have an adverse effect to GDP. So fiscal space is important. We have macroprudential regulation, but that is debatable about its effectiveness and about the timing of the implementation. Usually we would think that macroprudential would be preemptive tools, but if we do it wrong, it could be pro-cyclical if you do it after the cycle. Debt restructuring. Again, we have to trade off between the moral hazard issue and the welfare gain from a debt relief program. And of course, monetary policies is very complicated because the effect of debt to GDP is ambiguous. Monetary policy affect debt and GDP in the same direction. It's depends on the sensitivity or the elasticity of interest rate to debt and interest rate to GDP. And that also depends on the economic cycle. And to add the complication, monetary policy also affects the debt service burden. So if you increase interest rate, it could cause higher probability of default. And of course, if the world economy is doing well, it is likely that deleveraging it will be easier. So having this in mind, what are our approach from the Bank of Thailand? Well, we attempt to tackle debt at every stage of the debt cycle. We have the pre-debt period, when having debt period, and after having debt period. So for the pre-debt period, in fact, we have seen that inappropriate government policies can lead to adverse effect on household balance sheet. But if one cannot control the government, if one cannot control the politician, then we want to focus on the financial literacy, so that if they see, again, 15% price tag off from car scheme, they might want to think twice about their ability to service their debt. So we have a training program, especially on college students, that because those are the ones who will enter the job market, and those are the ones who have perhaps their first debt. We have that, and we have tools of social media, Facebook, and so on, infographics to educate Thai people. And then during the having debt period, we want to ensure that the financial institutions are responsible in their lending. We want to make sure that they properly assess the debt capacity of their clients. We don't want them to be giving cheap credits. We don't want them to underprice the risks of their clients. And one of the way, underpricing of risk is very hard to measure. But one of the way that we use internally is the conditional mean estimation. So basically, if you have a very granular level of data, you can use panel data, and you have a control on fundamental factors, and then you have a series of times dummies. Now, suppose you have LTV, and you see that LTV rise. You can control with the consumer profile, housing profile, the location, and all that, the loan profile. But after controlling all of that profile, if the series of time dummies, the conditional LTV, after controlling those profile, still rise, it could be a sign of underpricing risk. So that's one example. And also, lastly, we have macroprudential policies and regulation. In fact, we just impose credit limits on credit card and personal loans, effective just this September, which macroprudential policy experience, my colleagues will talk more on that. And lastly, we just launched a debt clinic, which is a debt relief program for the eligible consumers. But so far, it hasn't been what we were expected, because we were afraid of moral hazard problem. So we have a very strict guideline of those who are eligible, and we are still discussing on relaxing those guidelines. Okay. Lastly, I want to talk about some ideas on how to evaluate macroprudential policies, because this is a huge area that central bank really want to know. Is some kind of a black box, because there's a huge debate on whether macro policy is effective, and if we know whether it's effective, and if we know the effect of the unintended consequences, then we will understand better of the role of the monetary policies. Now, luckily that nowadays more and more macroprudential policies has targeted nature. Even the first paper that Ms. Lee present is targeted in different districts as well. So then there's numbers of econometric tools that we can use. First is the different approach. So basically, the affected, suppose the affected district would be the treatment group, and the unaffected district would be the control group. And of course, we have to control other things, and we have to assume the common trend assumption. Or another approach is regression discontinuity. Actually, the approach that Ms. Lee used is a special kind of regression discontinuity. So when we have a threshold, say, suppose we have a target income group, say lower than 30,000 baht. If we have enough micro level data, we can look at those people who is a little bit on the left of the 30,000 baht, and those who are a little bit on the right of 30,000 baht. And then we can think that those who happen to be on the left and on the right, they're actually a local, semi-local randomization. People don't decide whether you can be on the left or not. It just happened. And then we can run some regression on that because we have randomization. And that, then we can know the effects of macroprudential policies. Now, we just had the credit card and personal loan policies implemented in September. Definitely we can do this approach, the definitive approach and the regression discontinuity approach. Certainly we will do that. But for now, my colleagues will talk about another approach, which is using aggregate data. Doing the simple regression with macroprudential index.
Thank you. I'm going to discuss about the Thailand experience on using the macroprudential policy, and also briefly discuss about the exercise to find the effectiveness of the macroprudential policy. For the first part, the Thailand experience, actually the Bank of Thailand has implemented several forms of the macroprudential policy. In the next slide, if you see the table, you will see that while the financial stability assessment has been part of the information input for the Monetary Policy Committee, every time they decide the monetary policy decision, they also incorporate the financial stability concern into the decision. And on various occasions, we also implement the macroprudential policy to address the risk that build up in the particular sector, for instance, in the housing sector and in the consumer credit as well. There are so many ways to categorize the macroprudential policy. If you please go to the next slide. Oh, click. Oh, sorry. So I need to do it myself. Sorry. Okay. There are many ways to categorize the macroprudential measure, but for this slide, what we show is to categorize it by the nature of the risk that the central bank want to tackle. So the first one is the time dimension macroprudential policy. So for this one, this dimension aim to tackle the credit cycle or the credit growth as a consequence of the economic activity, and it can be divided into broad-based and sectoral measure. For the broad-based measure, the Bank of Thailand is still exploring the possibility. So this one means that it aims to moderate the credit growth cycle, and the most popular type of this broad-based measure is the counter-cyclical capital buffer. This means that when the credit lending institution they are charged with higher capital buffer during the period of the upswing. This is to avoid the excessive credit growth, and then the measure can be relaxed during the economic downturn. The second one is the sectoral implementation of the macroprudential measure. This one is more targeted to the credit-related risk in the specific sector. For example, in case of Thailand, we implemented loan-to-value ratio, which is the target on the housing credit growth, and also the debt-to-income ratio and the debt service ratio. This is to help restrain the household credit risk. Another aspect apart from the time dimension is the cross-sectional dimension. So for this one, it just addressed the risk of the potential spillover from the financial system structure. So this measure has been introduced just a few months ago in September 2017. For this one, it's just to, if you see the D SIPs here, D stands for domestic, and SIP is the systemically important banks. So for this measure, what we have in mind is that the failure of the important banks can actually have the significant spillover effects on the financial system. So that means the banks, these important banks, the DSIP banks, are required to hold extra amount of the capital buffer. This is in order to help reduce the probability of the failure. And for the third aspect is the macroprudential policy that looking at the balance sheet of the financial institution itself by looking at the asset liability management of the banks. This one aims to reduce the risk from many aspects, for instance, like the liquidity problem or the maturity mismatch or the currency mismatch. And this is just to prevent the risk in the liquidity or the solvency problem. And the type of measure are, for instance, like the liquidity coverage ratio, the net stable funding ratio, or the limit on the net open position of the foreign exchange rate of the banks. And the last one is the market volatility. This is similar to, actually this is the subset of the macroprudential policy that actually look at the risk from the capital flows into the capital markets that may have impact on the overall financial system, or what we call the capital flow management measure. So the example of the measure that we have in Thailand is, for instance, like the minimum holding period on the non-resident holdings of the securities, and also the restriction on the foreign lending and borrowing. Okay, for this one, what I would like to focus is on the LTV measure and also the personal loan measure, or the credit card and personal loans. Let's look at the left-hand side first, the LTV measure. Actually, the LTV measure or the macroprudential policy is not new to Thailand. We have been introduced it since early 2000s. And when we start, it is the strict ceiling on the LTV ratio, which is around 70%. And we target on the high value property, which is more than 10 million baht first. And afterwards, the measure become more relaxed. And then we start to look at the risk weight capital requirement instead. So we relax the LTV ratio to be 80% instead of 70%. And then we impose the higher risk weight on the capital charge. And after that, we more target on the low value property, which is less than 10 million baht in 2011 and 2013. And if you see from the table, actually we have more variation on the type of the property. So we start with the high-rise property first, which is the problem at that time. And then in 2013, we target on the low-rise property instead. Okay, and on the right-hand side, also we have the concern on the credit card and the personal loan as well. So we have implemented the macroprudential policy on the personal loan as well. And the form of the measure is the loan-to-income ratio. So the value of the credit card or the personal loan is capped to the certain limit. And the limit here is as a multiple of income or as the minimum monthly repayment. And after the discussion about the measure that we use, then this is the exercise that is the preliminary work of me, Sarah, and my co-author, Ranchana Pongsapan as well, but she's not here at the moment. So the preliminary work here is that we first construct the macroprudential policy index, and then we regress it with credit growth, and then we control for many factors that may affect the credit growth. For example, the government policy, the damage of the Asian financial crisis, and the GDP growth, and the monetary policy stance or the interest rates. So if you see from the figure, the blue line here is the LTV index. So the interpretation is that it starts from year 2000, which is the base year. So at this time, there's no measure, so the index equal to 0. And then in 2003, when we start to implement the LTV measure, the index become +1, which means more tightened, and then it keeps steady until we loosen it and become more risk weight. So the index reduced to 0 again. And in 2011 and 13, we tightened the LTV ratio on the low-rise property and the low value as well. That's why the index increased. And apart from the LTV ratio itself, we want to control the government policy as well. That's why we have the red line as well. The red line here is the special business tax on the property. The government has frequently waived the business tax. That's why the index become -1. That means it is more relaxed. Okay, and this is the regression that we use. And let me discuss about the result from the regression. So if you look at the left-hand side here, the blue area here is the lack of the housing credit itself. So you will see that actually the lack itself has significant impact on the credit growth. So that means that it has the persistent credit dynamics. And apart from that, the green bar here also contribute to the housing credit growth, which is the GDP. It is actually the most important driver for the housing credit. And the red bar is the LTV index itself. In this exercise, we use the change of the macroprudential index. That's why we see the one period red bar. And in the early period in 2009, when we relaxed the measure, so we see that actually the relax of the LTV measure contribute to the higher credit growth. And later on, when we tighten the credit standard using the LTV ratio, it does actually reduce the housing credit growth. And if you actually other impact also seems to be pronounced. For example, like the monetary policy stance and the government measure as well. And if you look at the right-hand side, this is the counterfactual exercise of the LTV. The blue line is the actual housing credit growth, and the red line is the exercise that we made. So we just use the simulation model to taking out the LTV ratio and see what will happen. If there's no LTV ratio, what will be the amount of the housing credit growth. So from the exercise, it shows as the red line, the red dotted line here. So what we see is actually with the introduction of the LTV ratio, it does reduce the credit growth by about 3 to 4%. And another interesting point is that actually the LTV, the credit growth without the LTV ratio actually converge to the actual level of credit growth. So that means the impact of the LTV ratio itself is not permanent. So let me conclude the finding. So the finding and the key takeaway here is that first, we should focus more on the preemptive action of the credit growth or the debt management. rather than waiting until it explodes. And the second key takeaway is that actually the enough of the policy space is needed while the private sector deleverage their debt. And lastly, we find that the macroprudential policy actually can dampen the housing credit growth, but the impact does not last long. So what we mean here is that actually the appropriate monetary policy mix and the macroprudential policy package is needed in order to be used to achieve both the price stability objective and also the financial stability objective. Thank you.